Hey, good morning, everyone. Marty Missouri here. It is Friday, the 1st of August, 2025, with just a brief commentary for you. I'm not going to call it my end of week roundup or update because I'm 99% certain I'm going to pop back in over the weekend after I do my deep dive into all the data. There was a lot of data this week, I think important data, and the Fed meeting, and I think lots to parse. Lots to explore, but this morning the reason I'm popping in is I just wanted to spend just a short bit of time on the charts that I've been talking a lot about lately, and then I will just briefly summarize the payrolls report that got the ball rolling this morning, and maybe a note or two from our internal notes. So with regard to the payroll report this morning, it was kind of a shocker to the markets. Not so much to us. Remember, I keep suggesting that we aren't as sanguine as a lot of people are about economic prospects right here based on what we're seeing under the surface. And maybe a little of that or a lot of that perhaps is finally showing up in the jobs number. And let me just give you a summary. So payrolls rose by 73,000. The estimate was 104,000. So 21,000 miss on the headline number. Here's the thing. The revisions for the past 2 months were really notable. 258,000 combined. So prior to this morning, we thought there were 258,000 jobs that were created that weren't. In fact, June only saw a 14,000 net increase in payrolls. The unemployment rate ticked up to 4.2%, as expected, as the household survey, and this is where they get the unemployment rate. So the establishment survey, where they get the jobs growth or contraction number, comes from business surveys. The unemployment comes from calling households. And the household survey actually saw jobs contract by 260,000. The U6 rate, which includes part-time and discouraged workers, rose to 7.9% from 7.7%, and that's a 5-month high. So, and again, there's more under the surface. We'll look at the composition of where the jobs were made and lost and so forth, and that may be the kind of thing I bore you with in my weekend commentary. The other thing that I noticed this morning that just came out was the Institute for Supply Management Manufacturing Index. It fell to 48 from 49, and below 50 means that via the sentiment indicator, the manufacturing space is actually contracting. Employment component of that index fell to 43.4, so that's well below 50, and it was 45 the last month. New orders were 47.1. That was up a little bit from 46.4, but again, folks, that means if it's below 50, that means they're going backwards. And then prices paid, now above 50 is not a good thing on this one, was 64.8, but that's down from 69.7, but that's well above 50, meaning prices are going up while a lot of the key data is going down. So all in all, not a good feeling coming from at least the ISM's manufacturing sentiment survey. Now, S&P's survey, the PMIs, those have come in a little better. So they're either asking different questions or talking to different companies or what have you. So anyway, lots of data. And by the way, there's still a lot of mixed data out there. Clearly, we're not in recession just yet. But again, we have our concerns. So again, lots more to talk about, I think, this week, and I will get to that. But let's just do what I promised and jump over here to the charts real quick. So folks, I've been kind of characterizing this as a heavy market. Just about every video I'm talking about these rising wedge patterns, reminding long-term followers of how these things too often play out, and that this looked pretty classic to me. Now here's the S&P 500 daily chart. Sell signal comes when you break below the uptrend line here of this rising wedge pattern. We got that yesterday, closed solidly below, and then we gapped lower today. The fact that you see this blueness of the candle concentrate up here means it was as low as this, and it's coming off those lows so far this morning. Up here, you notice my dotted rectangle. So another thing that you don't want to see if you want stock prices to always go up is you do not want to see a bearish engulfing candle at all-time highs. This is a negative pattern, and they tend to have the highest success rate when they come at levels that are seemingly extreme, at peaks and at troughs, so to speak. So you can see this engulfing candle captured all plus of the last week or so. So 5 or 6 days, 5 days, including today, actually 6 really, are captured in that engulfing candle. So again, that's a pattern that we don't take as seriously when we're in the middle of a new uptrend or downtrend, but we do have to respect it along with these other patterns when we're at all-time highs in stocks. Coming off of very overbought levels, that's very overbought. Remember earlier this week I showed you a monthly overbought level, and I showed you the last 30 years we have not resolved from those without double-digit declines in stocks. I think this 50-day moving average is going to be very, very key. If we get there next week, I expect the market to find support there, unless there's just some additional bad news that just sends us, careening through there. Then the 200-day moving average is where I think the market may find some serious support from here. And that's quite a ways lower than we are right now. And, just what just also came to mind is I allude to the options action. Remember, I think it was last time, but a lot over the last 4 or 5 years, I've been talking about the huge volume in the options space and how the dealers in that space have to hedge their positions. So when the market is screaming higher and people are buying call options, the people who sell them those call options are actually buying the underlying security. And yeah, I did talk about this week. They're buying the underlying security to hedge them, to hedge their position. And I said that now when those calls expire, or if they get abandoned and get sold because there's some news like today's jobs number, well, then all those hedges that the dealers own get sold instantly, and that exacerbates the downside. Then if people rotate to puts, well, then they have to short stocks, if it's stocks that we're talking about. So look for, in this world with all this leverage in the option space, look for an increase or an exaggeration of a move in one direction or the other that really has nothing to do necessarily with the news of the day. And so, consequently, for us, we just rolled our hedge because they were so cheap and they were getting burnt up. They were due in September. So we rolled our S&P 500 put hedge out to next March, and we actually moved the strike a little closer to the money. I know that's getting into the weeds, but of course that's helping out our core portfolio today. And speaking of that, clients, I know most of you are clients who view this. The core portfolio, and this is for those of you who just have our core allocation. A lot of you may have some preference items that you wanted to hold, or legacy assets in a non-retirement account that are just too costly from a capital gains tax, and we have to manage around those. So your return may or may not be as close to the core allocation as I'm talking about. So just our base core allocation as I speak right now is only down 0.14%. And if you like to compare to the stock market, the Dow is down 522 points or 1.18%. It was down over 700 a little while ago. S&P is down 1.38%, and the NASDAQ is down 1.5%. And those are big one-day moves. The VIX is up 19%, the volatility index, which means options are really moving today. So why is the core flat, essentially, at least right now? The day is still young. Gold is up 1.75%, although we're only up 1.2 because of our gold hedge, which has been good to own, and I'll show you the gold chart for a few days. So we're giving back a little bit of that, but that is sure helping because that's not a small position for us. The move in gold is helping. One of our emerging markets ETF is flat. Consumer staples, right? People will roll to staples when they're afraid of the economy. That's a big position for us in the U.S., and that's 0.5% up and so on. So some diversification in defensive areas, and that's what a diversified portfolio should look like, is helping out. The yen is up big time today. So our position in the yen is up almost 2%. And so these things are helping out. So every single position we have has a thesis, and right now we're mixing asset classes because there is a lot of ambiguity about the second half of the year. I've given you both the bullish and bearish cases, and I think they're both, worth giving serious consideration to. Our two top research providers, we form our own opinions, but we definitely want to know what the people and the analysts and economists whom we respect think, they're at odds with one another. BCA thinks a recession's coming. MRB says no way. And I read all of their stuff, and they all make some sense. So we'll see what happens. There's a lot left to play out. The NASDAQ 100 index, same thing. You've got a bad-looking bearish engulfing candle. You can see it's come way off the bottom, even though it's still down 1.5%. So the NASDAQ must have been down more than 2%. This 20-day moving average seems to be an important one for this index. Gapping below that is not a good sign. We will, eventually come back up and fill that gap. But right now, if it should come back and test that, and if it fails that, then we're going to have a discussion around the 50-day moving average. The dollar is getting absolutely hammered today. So this move out has been pretty impressive. We anticipated that. We talked about technically it looks like it's due for a bounce. It'd been getting it consistently. And then today with bonds rallying hard. By the way, our long-term treasury bond ETF is up 1.33% as I speak. And so the dollar is taking a hit on the yield differential aspect of it and rotation, out of the U.S. equity market for one, so far this morning anyway. And here's the yields. The 10-year actually plummeted today. So, folks, notice here, because lots of people I talk to, and certainly lots of attitudes in the media, say the Fed needs to cut rates because interest rates need to come down. Well, the Fed didn't cut interest rates yesterday. And look what the 10-year did. And mortgages, by the way, are largely indexed to the 10-year Treasury bond yield. So the Fed did not move, and interest rates dropped. Okay, so the Fed moving in an environment where interest rates aren't poised to drop will actually send it in the other direction. The Fed cut 0.5% last September, right? Look what interest rates did in response to that. And I will say in response to that. Why? Because it didn't make any sense. It was bad timing. Now, what I've been saying is bad timing for the Fed to be cutting interest rates again in here. But I've also been saying by the time we get to September, we think that there's a good chance the Fed will be needing to cut. And that was supported by today's jobs number. And then gold, which has been technically an absolute mess, the way we look at the technicals, therefore we've been hedging, was finally, giving it up. If we would have had a good jobs number today, I can tell you with a great deal of confidence that gold would have absolutely tanked. But it's having a nice rally because now there's uncertainty. Yields are dropping, the dollar's dropping. Suddenly gold right now is dancing back with its 50-day moving average. That's either going to be resistance and we're going to roll back over, or it's going to rise up there and then we're going to be talking about more support. I still want to hedge our gold position right here. Okay, and then lastly, let me just go ahead and talk about some notes I made. Okay, so with regard to tariffs, folks, and I want to just always remind you, there are no politics going on here at PWA. Let me just throw that out there. As for the impact of tariffs, just a note from Peter Bookvar from this morning, and I was paying attention to this as well in terms of Ford's statement. Ford is telling us that tariffs will cost them $2 billion this year after they do everything they can to mitigate it. And they assemble almost all of their cars in the United States. So if you want full vertical manufacturing of everything that makes a car, you will have unaffordable cars for many and will be completely priced out of the global marketplace. That's essentially the message of Ford's message right here. $2 billion is what that's going to cost them this year. So again, the tariffs are going to be a moving target. I know we're getting these agreements, but that is so fluid. I think if the market demands it, you will see that scenario get better. And that's why maybe we shouldn't be as doom and gloom. If better deals are struck and tariff rates are lowered, the market's going to celebrate that for a while. From yesterday's notes, I mentioned MRB. I said that the following mirrors our view that equity markets have rallied of late based on the progress made in terms of tariff rates being lower than earlier threatened, despite the fact that the recent agreements establish a regime that matches or exceeds those of the Great Depression. Just remember what I just said about Ford. And that almost all risk markets have elevated prices and valuations, and I've hit that one pretty hard. So again, my point has been over and over again that if you said that we'd have a 15% average tariff rate, which is what we're looking at, in January, the equity market, for example, would be a lot lower right now. But if you say it's going to be multiples of that higher, and then you come down to that, suddenly the market sentiment, animal spirits for stocks pick up, and you buy them. But then you wake up one day and the fundamentals tell you, that was the wrong assumption. This is still too high. And that in all likelihood, the U.S. will suffer worse, as is happening today, despite the rotation of U.S. equities over the last couple of weeks. These are all my commentary. All that said, we are not as sanguine as they are on U.S. economic prospects over the next 6 to 12 months. And again, our view is getting supported, at least for a moment, with this morning's jobs number. Although I do sympathize with their point that aggressive Fed easing outside of clear recession risks would actually cause rates to rise. And I just talked about that just a second ago. Okay, so just to keep it quick, I'll just touch on what I highlighted here. Investors have embraced the fact that there has been some progress with tariff rates well below the extremes that had been threatened. Hopes for a successful conclusion are running high. That's essentially what I just said, but these are MRB's notes. The magnitude of the celebration in equities is puzzling from a long-term perspective, emphasizes what I just said, and likely reflects the short-term nature of investors' attention and still a lot of liquidity out there in the market to push asset prices higher. This policy, if it were to stick, is stagflationary, right? The inflation is not coming down, and the economy is beginning to show some weakness. If the Fed were to meaningfully lower the policy rate, perhaps under intense political pressure, would result, they say may result in long-term yields like it did, as I've illustrated multiple times the last few months, like it did during that cut last September. Critically, relatively better equity valuations in the euro area versus the U.S. may finally encourage global investors to rotate further out of the U.S. into the euro area. They show a chart. That happened a bunch first half of the year. It's been going in reverse the last few weeks. Fundamentally, long-term, I think that makes a heck of a lot of sense. So we've been stubbornly hanging on to our European exposure, at least for now. And I think that's enough. I talked about the bloated tech sector as a percentage of the S&P last time. So folks, I will just leave it there. Went a few minutes more than I anticipated. I don't think it's critical that I bore you one more time over the weekend, but I just might, based on my data collection and assessment of everything that's going on out there. So I hope you have a great weekend, and I'll either talk to you this weekend or middle of next week. Take care. Bye-bye.